Hello guys, today I have another educational video for you guys, and today we're going to talk about this famous topic, the power of compounding. So I'm going to explain to you what power of compounding is, why and how it arises, and why many investors prefer investing, long-term investing than trading. So what is power of compounding? So let's say first let's go through what compounding means. So suppose you have 100 rupees and you have an interest rate of 10% or a return of 10%. So in simple, there are two interest rates. One is simple and another is compound interest. So in simple, what happens is, let's say the duration is for 5 years. So what happens in simple is, this 100 rupees first grows to 110 in 1 year, because 10 rupees is what is earned as the 10% of 100. So first it has 110, and then in the second year this 110 becomes 120 as another 10 is added, and so on. So every year there's an increment of 10 rupees, because that is 10% of 100 till 5 years, until it becomes 150. Now we look at compounding. Now what is the difference between compounding and simple interest is, on year 1 we have the same 110 rupees because that's 10% interest earned. Now for the year 2, the 10% interest is not earned this on this 100 rupees, it's earned on this 110. So we add to this 110 10% of 110 and not 10% of 100. So that would be our 110 plus 10% of 110. 10% of 110. Now that would be 121, right? So on the second year here we have 121 and so on. So after the end of 5 years we would have a total of 100 into 1.1 to the power 5, which is 161.05. So here you can see that the difference between simple and compounding interest is this 11.05 rupees. And 11.05 rupees might seem small to you, because this is only done for, we only considered for 5 years as total here. Now if this duration is increased to, let's say, 20 years or 25 years, then the difference would be even greater. So the reason behind that, suppose you invested in a company and the price of the share is 10 rupees today, and the results were good. Now the result is announced and the results were good, so the stock price jumped by 5%. Now the price of the company is, price of the share becomes 10.5. Now this is, you earned 0.5 paisa in this price increase. This is what you made. Now let's assume that after a long time this very stock which you bought for 10 rupees is now 100 rupees, and then again there is again the results announced are very good, they're above expectations, so you have another 5% increase. Now this 5% increase will be on this 100, so the stock price becomes 105. So in this increase you have made 5 rupees and not just 0.5. So as the stock price keeps going up, even a small percentage change like a 1% change, as the stock price keeps increasing, even the small percentages would be a huge increase in your initial investment. Because if you consider this is 5% of your investment, but 5 rupees is 50% of your investment. So you're actually making 50% return with just a 5% increase in the price of the stock. So this is what is called power of compounding. Now let's look at which Let's look at the long-term chart of this is of S&P 500. So this starts all the way back from 1930s. So 1930, this was the Great Depression, and came S&P fell all the way down to 85, and then right now it is at around 3,600. So this period you see right here, this was the bull run for S&P 500 from 1982 to the 2000s. This is where all the greatest investors emerged from. You have your Warren Buffett, you have your Peter Lynch, Rakesh Jhunjhunwala, Radhakrishnan Damani. All these people, all these investors were invested in the market in this bull run right here. That is where they made a lot of their money, and then their capital increased by 50 times, 100 times, and this is where the power of compounding mainly came into place. So for Nifty, in the last 20 years, Nifty has a CAGR of 11.1% in the last 20 years and 8.87 in the last 10 years. So CAGR stands for compounded annual growth rate. So per year, Nifty has given a compound interest of 11.1%, a compounded return of 11.1%. So if we say that Nifty, if we assume that Nifty is gonna keep growing at 11.1% every year for the next 20 years from now, and you can, this is a calculator, this is the power of compounding, compound interest calculator. You can search online and you'll get it. And making monthly investments of, let's say, just 5,000, you can select monthly 5,000, and you want to invest for 20 years, and then you want to stay invested for 20 years, and you expected a rate of 11%, which is the market average market return. Now this, your 5,000 monthly has grown to 43.68 lakhs. So this is the power of compounding. So if you calculate how much your total investment is, so that would be your 5,000 into 12 months into 20 years. So your total investment was 12 lakhs, and then you got 43. You've almost more than triple your money in 20 years. So that is precisely what the concept of power of compounding is. And this was done for 20 years, but then if you plan on holding it till retirement, let's say for 30 years, you'd be a crorepati. It's 1.5 crores. So this is what the power of compounding is. And you made 1.5 crores just from investing 5,000 monthly. So market in the very long run is always bullish because economy is always developing and inflation is always going up and companies are always emerging and doing better and better. So this is why people prefer investing over trading, because of this concept of power of investing, power of compounding. So that's it for today. Thank you.